Look, macroeconomics isn't necessarily the most interesting topic in the world, but I think with what's happening in the housing market and housing industry today, it's a really important one. And I think everyone needs to know at least a little bit about it. So I thought I would speak with the Deputy Chief Economist of Redfin, Taylor Marr, tackling all the things from inflation, rates, even things like global turmoil, investor demand, and just to get a little bit better understanding of some of the macroeconomic factors that has affected and will affect housing in these very, very volatile times.
This is Notorious POD, the podcast for the best informed people in the real estate industry. Rob Hahn is your host, and Notorious is where the real estate industry comes for real talk with no bullshit.
Hey everybody, welcome to an episode of the Notorious POD. This is your host, Rob Hahn. Thanks for joining me. Today I've got a wonderful guest. We're going to talk macroeconomics. I know, your eyes are rolling back. You're like, oh my God, can I skip it? It's really boring. It's really not. It's really important. I actually just had a presentation yesterday with HomeSmart and talked about how, look, in this market and what's happening with housing, I think it's sort of important to pay attention to a little bit, at least, to understand some of the big factors. And to help me kind of think through that, I have a special guest. Let me introduce Taylor Marr. He is the Deputy Chief Economist for Redfin. How are you, Taylor?
I'm doing well. Thanks for having me.
Thanks for joining me. It's I figured, you know what? I like I say, you know, I only look like an economist. I'm not an economist. So I thought, you know, as we're talking about this, as we're talking about this, let's actually get a real economist, you know, is trained and probably has a lot more data and a lot more knowledge and understanding on to kind of help us think through it. So let's start with sort of the top line, you know, and as I mentioned, I went and presented, you know, I've been talking about this for a while now about sort of the macro factors that's really influencing housing. You know, when I look at it, like, these are the things that tend to drive the housing market. It's going to drive the experience of real estate agents, real estate brokers, buyers, sellers, landlords, tenants, all of it. And for me, one of the big overriding factors is kind of the monetary policy and the inflation environment that we're in. You know, as we know, you know, the nominal headline inflation is 7.5%. And you and I have talked about it a little bit, and you wrote an article about this. I think it was quoted in Globe Street, which I said, let's reach out to Taylor. But give us the high level. Sort of what is happening with sort of the inflationary environment right now?
Yeah. So in short, inflation is just simply how are prices changing in the economy. So what a lot of researchers do at the Bureau of Labor Statistics is basically compile a basket of goods and measure how those prices of that basket of goods is changing over the course of a year. And so that's the CPI, the Consumer Price Index, which rose 7.5% through January. But beneath that, there's actually a lot of different measures of inflation. The Fed actually pays attention to a little bit different number called the PCE, and that actually came out today. So you know, that shows a little bit different rate of inflation. You know, the core PCE is 5.2%, but there's also just a wide variation of inflation, which we got into in our report, which is at the metro level. Some people are experiencing inflation rates, the rising cost of living, as upwards of 10% in places like Atlanta and Tampa. Yet other places like New York or the Bay Area are only experiencing 4 or 5%. And obviously, it depends a lot on how much you spend your money on gas if you're driving every day, or how much you spend your money on, you know, buying a new house versus you just stay put, you work from home, you don't travel. Yeah, you're going to experience inflation in a very different way.
Right. But one of the things about that, and so this is an area where I think I understand it, but I'm not sure I understand. So let me kind of try to have you explain.
Yeah.
One of the criticisms of CPI, right, that's kind of out there among especially like gold bugs and people who think the Fed is lying to us, is housing as a component of CPI, right? And I think what they point to is, look, how home prices are up 19% year over year. Housing is the largest component of any family, right? Any person. How is it that inflation is only 7% when housing is up 20%, et cetera? So can you tell us a little bit how housing plays into inflation and CPI, how it's constructed?
Yeah, so housing shows up in a number of ways, but you know, if you're just reading the headlines, looking at the headline data releases, So we mentioned the CPI was at 7.5%. Within that CPI, there's a whole range of goods. Energy is one of the key drivers, and that's up 27% year over year. Whereas shelter, which includes both the cost of rent as well as the cost of owner's equivalent of rent, which is the for sale housing market, that was only up 4.4% year over year. It does carry about a third of the weight in the CPI, but anyone looking to move and looking at new leases on a rental or looking at buying a home would just laugh at those numbers as you did, because 4.4% is ridiculous to anyone who's been tracking what's been happening in the real estate market. And so how they measure inflation is, the CPI is a survey that the BLS will carry out, and they'll ask people, if you were to rent your home today, how much would you have to pay in rent? And, maybe they were able to rent their home for $2,000 a year ago, and now it's $2,100. And so you get a 5% inflation via that survey with that component of shelter. Whereas Redfin, we have a lot of data on the housing market, both in the rental market as well as the for sale market. And some data we recently released is that the median home sale price was up 14% year over year in January. And overall asking rent was up 15%, looking at the typical new lease. And when you combine that with the effect of rising mortgage rates, the typical person who's buying a home, if they were shopping for a home a year ago versus today, they would face a median monthly payment on a mortgage 24% higher. So that is just, a dramatic difference from this 4.4% growth in inflation. Yet at the same time, you do have a lot of households that locked in a mortgage. The majority of households are homeowners, and the majority of those homeowners have not moved within the last year. And if they locked in a mortgage payment last year, maybe they were able to refinance for 3 or under percent and lower their monthly payment, and maybe are even spending less on a monthly mortgage today than they were a year ago. So that's a little bit of the nuance too with how people are experiencing inflation as it relates to housing.
So what do you think is the actual inflation rate in your view? Like, what's your take on it?
It's difficult because everyone's experience is different. But I really do lean more towards these numbers around 5 to 6% that the PCE that came out today, reflective of January from a year ago, is showing. And the reason why, let me just get into this, is because the PCE adjusts for how people change their consumption patterns. So as an economist, we like to talk about demand and supply curves. And if you've ever taken Econ 101, you know that the demand curve is downward sloping. And what that means is that when prices rise, you get fewer people consuming that good or service. And as we've experienced rising prices, for example, of food services, of gasoline, people have consumed less gasoline and they've consumed less food. And so that is one way that the PCE sort of makes this adjustment, is just looking at how are people spending their money. If the price of ketchup rises dramatically, they might shift to just have mustard on their hot dog. And I think that's more how people are experiencing the rising cost out of their pocketbooks. Now, both are right, because the rising cost of prices is still measured and people will have that experience. But that shift in consumption patterns, I think during the pandemic especially, is very important. As people maybe are using a little bit less gasoline, they're not quite experiencing that same rate of inflation that we might be measuring. But I mean, these are really volatile times. Prices on everything is changing dramatically. And as I said, it's going to hit everyone very differently depending on where you're located, what type of job you have. Do you have a locked in mortgage payment, or are you someone who's moving for a new job? And then there's, we're just talking about the cost side of the equation. Hopefully later we can also get into the wage side of the equation.
Oh, we certainly will.
Which really balances this out.
In fact, let's get into right now. What is happening with because I've been pointing this out, right? Which is like home prices, price of everything really is just straight up and to the right. Whereas real wage growth is actually negative. It's been flat for decades and it's actually negative. Like, what is happening on that side?
Yeah, wages are really tricky to look at this part because they all measure different things. We can look at how much is the typical worker getting paid, how much is their pay rising. But then as you get new people entering into the labor market, taking those entry-level jobs, that can pull down the averages in some ways that really changes the analysis. So overall wage growth in January, according to the latest data, is about 5.1%. pretty close to that core PCE number I mentioned of 5.2%. But you're right. Still, on average, people are not really experiencing wage gains in excess of inflation. The real wage gains, which is adjusted for the cost of living, is largely negative. However, that being said, if you think about someone in the market to rent a new apartment, to buy a new home, their wage gains, or really their overall economic well-being, might be very different than if we just look at the average hourly earnings, for example. And how that plays out is a few ways. So first, job switchers actually have higher rates of wage growth. It's closer to 6%. It's easy to get a raise by switching to a new job. At the same time, we're at Redfin reporting a record number of people are looking to relocate. And we see a lot of home buyers shopping that are leaving a place like California, buying in a place like Arizona or Texas. And these people typically have higher budgets than locals, and they're able to afford this higher cost of housing. This is one reason why our report, looking at the variation in inflation by metro area, really ties the relationship with migration, because people are moving there from really high cost areas into places like Atlanta and Tampa that are experiencing this 10% growth rate of inflation. And they're able to bid up the housing and arguably afford it. We found that the majority of people who relocate are actually increasing their disposable income. So even if their income stays flat, or maybe they even had to take a pay cut because they're a tech worker moving from the Bay Area to Austin or Raleigh, if they're one of those people who took a pay cut, if we're measuring their income, it would look like real wages are definitely not keeping up. But their disposable income, because they're saving a lot on housing costs, especially the monthly mortgage payment, that's one way that overall people's economic well-being might actually be a little bit better. And that's showing up in our data when we look at, how much people are spending on their housing, if they're buying with Redfin, relocating to a new metro area, and how they can afford these higher payments, when it's all said and done.
So that kind of leads to one of the mysteries, right? And one of the mysteries is, okay, I have this thesis, just looking at all the numbers, where I say, look, families can't afford this anymore. Everything just is okay if wages are flat. And you're right, maybe if job switching, and the exception would be things, okay, you're a tech worker, you move from San Francisco, you move from LA, and you're selling your $1.5 million, whatever. Okay, but the thing is, if you're selling, you're already in the property ladder. I'm thinking you're a renter. Right. Mm-hmm. And you're paying $4,000 a month in rent. If you move to Austin, it turns out you could buy a place and only pay $2,000 in mortgage. Okay, so that leads to something that I've been really curious about, right? Which is, I've been saying for a while that consumers just they're getting priced out of the market. I think you guys actually had a report to that extent as well, right? Okay, so inflation's happening. Rates are going to go up, which we haven't really talked about rates, but the Fed is going to hike rates. Mortgage rates are already, I think, at 4.25% as of yesterday. So even with this moving, okay, from LA, you could move and you could actually afford to buy a place, like that is happening. But on the whole, it feels to me like consumer demand should really drop, right?
The macroeconomy is a complex thing, and there's a lot of inputs and outputs to overall someone's ability to afford things. We talked about wage gains a little bit and the nuances there. I'd also like to talk about savings. And in the pandemic, there was massive stimulus money going into most households. So there was the child tax credit, that went to the majority of households. A lot of other stimulus money, unemployment insurance was very generous and helped a lot of households stabilize their incomes. Overall, during the pandemic, we have about $2.7 trillion in excess savings accumulated. And excess savings is, what would have been saved had the pandemic not happened, just follow the baseline. And then once you include all of these additional measures of income that households were able to get, that's substantial. At the same time, personal income per capita in 2021 was the highest rate at 7.2% year over year since 1984. So there was actually a pretty large, substantial increase in the overall economic health, the ability to afford things. So despite record high home prices, by some measures, they grew about 19 or 20% year over year in 2021. Home sales actually increased to 6.9 million. That was, tremendous. And so clearly some households are able to afford. That said, though, I definitely don't want to overlook that there are a lot of households that have seen real wage declines, that are not on the property ladder, that are priced out of the market and therefore forced to stay in the rental market. For those that are taking new job opportunities, maybe they get a little bit of higher pay, but they're forced to, sign a new lease by moving to a new neighborhood or even a new city for a job. And those high lease renewals or new leases, which I cited was about 14 or 15% year-over-year growth right now, those are not the winners in today's economy. There are a lot of people who are not benefiting from the stock market's performance in 2021, even if that's come down a little bit this year. So there are definitely a lot of people. If you live in Atlanta and your cost of living went up 10%, your wages probably have not. In fact, the average wage in Atlanta during that time was about 3 percentage points lower than inflation. So about a 3% real wage decline for the typical Atlanta person. And so that is a real concern, I think, that people have. And, that demand that is not going into owner-occupied housing is staying in the rental market. And that's one reason why rents are actually rising so rapidly. You have a lot of household formation, which is just ultimately new demand. And it takes a long time for supply to keep up. And we're building a lot of homes, but it's not enough.
So this is one of the mysteries, right? Okay, so consumers, and again, you all through 2021, I've been hearing, and you've been hearing, and I'm sure you guys have been seeing with your data, that consumers are starting to just get fatigued. They're like, okay, the home is now completely out of reach, or I'm making offer after offer after offer, losing them all to these cash buyers, and I'm done with it. I'm tired. I'm out. Right? I mean, that's the story that we've been hearing from a lot of brokers and agents on the ground. Yeah. And yet 6.5 million home sales, right? And yet demand through the roof. And January numbers did not come back as bad. So I want to share this video with you, because that at least there's one explanation, but just kind of get your take on it as well. So this is Ivy Zellman from Zellman & Associates, who she is a housing analyst. I think she's one of the best kind of in the industry. She's been, correct on a number of calls. This is a very brief video. It's only 3 minutes on CNBC. So let's just look at it together and react to it, right?
Welcome back to the show. You've been warning for a few months now of a turn in the housing market. Is this sort of boom lasting longer than you expected?
Actually, yes, Sarah, it is. I think that part of it is really given the backdrop of the fundamentals being so strong. We also have a significant acceleration in non-primary buyers, investors. So if you look at the existing home report today, the cash buyers were up 27%, while those getting a mortgage were down 13%. And what the NAR does is they sample realtors and say how many investors separately are buying, and that was up 22% year over year, up from the prior month of 17%, and the prior month before that 15%. So, today it's very difficult for primary buyers to compete with cash buyers, but yet we don't really know if affordability is challenged as much on those entry-level buyers, which are down year over year 20%, because we can't really ascertain, given that the investors are scooping up all the homes faster than they are. And just to keep one other stat, and then I'll let you go, Sarah, but luxury sales up over above 1 million are really strong, up 39%. So it's quite an interesting dynamic, but investors, we don't know what's going to slow down their interest in an inflationary environment. It's a great place to hide.
Let me stop there. I mean, what's your take on it? I know you guys, have published some stuff around investment as well.
Yeah. So let me start with just the current sales environment, which, according to the latest data releases last week by NAR and just the other day by the Census and HUD on new home sales, together, those two combined puts the total sales volume for January at 7.3 million, seasonally adjusted. Right. That is extremely high, higher than any time pretty much in the last year. And so, we're moving into a year. I think a little bit of that is probably accelerated demand, as in the fear of missing out, FOMO from rates rising, buyers trying to rush ahead and get on that, and probably not sustainable level of sales volume right now is my personal take. But that being said, investors are clearly a huge driver in the market. We just put out data for the fourth quarter of 2021 that investor market share reached 18%. And we, a little bit different in terms of how we're measuring investors. We look at the public records, include all the LLCs, corporations, trusts, all of these different purchases by investors, including iBuyers, and how much. And so that's a record.
But just real quick, though.
Yeah, go ahead.
Just real quick, your data on investors, you do not include like families who might be buying a home for investment, right? Like individuals, like I'm going to buy this condo because is that data even available? You could say this is a second, third home, so it's an investment property.
Mm-hmm. That is available in a couple different ways, but you're right. There's a lot of nuance there. So with mom and pop landlords, sometimes they do purchase through an LLC. So that way, as a landlord, they can limit their liability if something goes wrong, that, they don't lose their primary residence or other assets. But that being said, you're right. Like if you are a primary resident and then you buy a second home and then you move into that and just decide, well, I'm just going to rent out my old home. I actually know a lot of people that did that this past year. Right. And that's not going to show up as an investor data, but it is really becoming a landlord nation of people purchasing second homes, quote unquote, and, renting out. And we do report data on second home trends. It's skyrocketed during the pandemic. It basically doubled during 2020, at the end of 2020, compared to pre-pandemic levels. Right. And the demand dropped sharply after March of 2021, when some tighter lending restrictions were in place for second homes. But then those were loosened at the end of 2021, and it shot right back up. On April 1st, we can expect additional fees to hit people buying second homes again. And so I would expect some of that demand to pull back after that point. So, but yeah, no, that in combination with these Wall Street investors, the iBuyers, all of this is really, these are additional housing demand that doesn't show up in the form of like net new households, for example.
Right. So, I'm just pointing out that potentially your 18% market share for investors could be higher. Because, we have seen other reports that it's as high as 25%. And in some markets could be like 30, 40%. It's extraordinary.
That's exactly
right?
Mm-hmm.
So, okay. So I stopped you there. One of my big takeaways from Ivy Zellman, her thing was, and I've heard her speak on a different program talking about all of the gains in housing for January and maybe even December, like potentially Q4, all of the gains, she's attributing it to investor appetite, right? And her take is because investors are looking for inflation hedges, right? And they're looking at real estate. It's an amazing hedge. And she talks about even this, like they're running to single family residential, running to housing as a place to park their money, as a hedge against inflation. Do you guys have any data around that at all? What's your take on that?
Yeah, I would definitely agree that a lot of the increase, I don't know about all of it, definitely comes from these investors, bidding up homes, especially in some markets. They're, playing a large and outsized role and perhaps creating additional demand, which contributes to price growth. But I actually think investors are more reactive. They see strong demand in a market and then they follow. So I think most people get the causation backwards, where they look at 20% price growth and then they see a high investor share and they think investors caused that. I actually think investors are maybe even just a little bit ahead of the curve in terms of thinking where price appreciation is going. And that being said, the industry forecasts, most people are forecasting that price growth is going to ease. And in the same way, investors are not wanting to lose money. And so, they as well might want to back off as price growth eases. But you're right. A lot of the trends driven right now is actually single family built for rent or building up single family rentals. And there's still really strong demand there as household formation continues to be really high. And so that I think is a key segment that investors might be moving some of the housing stock from basically owner occupied into rental or tenant occupied housing. Now, that being said, they're still building a lot of construction, and eventually what really matters is what's household formation look like, and then how is the net new housing units keep up with that, which sounds really nerdy, but all that to say, if you just move supply from the for sale market to the rental market, eventually that excess supply depresses rents if you don't really have the household formation to meet that demand. And, as a result, it sort of kills your own strategy. It's sort of a self-defeating mechanism. And this feedback loop of, prices or rent growth really reacting to how supply is being moved around. And this includes the short-term rental market, which has been really strong. But that's sort of one constraint on this sort of running away forever. is, you build a lot more rental housing supply as we are in 2021. About 16% of construction starts were in the single family built for rent segment. So, they're adding supply. That's going to cool rent growth and maybe limit some of this, mechanism of shifting things from one to another.
Yeah, we hope it's going to cool rent growth, like you said, because the cure for high prices is high prices. But I don't know, So, but because you mentioned one of my favorite topics,
okay,
household formation.
Yeah.
You said household formation is really high. Like, tell me what you mean, because from what I can tell, people aren't getting married. So, what do you mean by that?
Yeah. So the total estimate of households, there's about 127 million households in the U.S. today. This is measured by the census. Every month they estimate it. And everyone's probably seen the headlines from the census that we had the lowest population growth on record ever. And that was driven by declining birth rates as well as higher death rate, as the pandemic did increase the number of deaths in 2021, but also record low immigration levels. And so that decline in immigration, of net immigration into the U.S., slowing birth rates, all of that contributed to really record slow population growth. However, you can have the same population, but two roommates decide to split off and each buy a home or stay and rent a home, and that's a new household. Families coming back into the U.S. that maybe were abroad during the pandemic is a new household in the U.S. Families getting divorced, that's a new, that increases household formation. So there's a lot of ways, that millennials are moving out of their parents' basement if they, stayed there for temporary during the pandemic. And all of this increase in households is really just increase in housing demand. And that's the main reason why we are at record low levels of rental vacancy as well as homeowner vacancy. And so the vacancy rates, the number of units that are just simply sitting open, is at record lows in both the for sale and the rental market, solely because of all of this household formation that's pouring into both segments. Okay,
so just to be clear, when you say household formation, you just mean, what does that mean? So like, to your point, if a couple gets divorced, there's two households?
Yeah, so they were living in one house, they get divorced, and let's say one person keeps the house and the other one buys a new house, that's a net new household. So if they get divorced and the husband moves in with his brother, then there's only one household formed? Is it basically, are roommates considered a single household or three different households, or how does that work? No, so roommates could be one household. If they're renting together, they're roommates, that would just be one household. So household almost feels like it's counting houses or residential units as opposed to people. And when you're analyzing the housing market, this is something a lot of people get wrong when they look at housing indicators and they just divide by the population of the U.S. and they say, well, per capita, we're actually not building enough housing or whatever. The right unit is really per household. Looking at the number of households, because and hopefully we can transition now to talk about demographics, because we have this wave of millennial households that grew up in a household with their parents, and now, are in prime age to be buying a home. And so there's an increase of about 10 million millennials relative to the next generation, Gen X. And so those extra 10 million millennials, feed into this household growth as they move out and form their own households. Right, but so we are going to talk about demographics, because this has been my obsession for well nigh 10 years now. Yeah. Because we all keep hoping that these millennials will grow up, and then they're going to start getting married and have kids and all of that, and it's just not happening. Right? In other words, we might have household formation in the sense of they're moving out, of their parents, but they're not getting married. They're not forming families. They're not having babies. So, so I guess a way to think about it is there's a difference between household and family. Maybe household formation is happening because all these millennials are, single and whatever, but they're not getting married. All right. So the issue with that then is marriage and correlation to home ownership is extraordinarily high. So it almost feels to me, Taylor, like you're describing a future where millennials, sure, 10 million additional millennials, household formation is super strong, but the vast majority of the household formation is going to be renters.
right? And they're never going to get on the housing ladder. They're not going to get married. They're not going to have families. Like, what am I missing here?
Yeah. So there's a variation of opinion here. So,
of course.
So humbly, I'm going to say that I personally believe that a lot of millennials are simply delaying a lot of these things, and that's okay. They went to college, they borrowed a lot of student debt, they got an education. What they did is they invested in their future, and that might cause them to delay purchasing a home, to start a family, to get married. All of those things are delayed probably as a result of increased education, increased student debt. But that delay does not mean that that's not going to happen. Sure, it might happen at a lower rate relative to Gen X. There's, changing preferences on things. But eventually, even if they don't have 2 kids, but they only have 1 kid, or even if they have no kids, they can still shack up with whoever they're cohabitating with and not marry, not have any kids, and that's still forming a new household. And so that
it would be decreasing household though, right? Hold on. So to be clear, okay, so boyfriend, girlfriend, right?
Yeah.
Start living together. You would remove a household, right?
It depends on if they were rooming with other people first. Let's say they each had a roommate before that, versus if they were living alone. And we do see a rise of people living alone. So you're right. If 2 people living alone get together, they form one new household instead, that would decrease it. But if they each had a roommate, maybe their college roommate, they were working their first job in the city, and then they go off and marry each other, that would add a new household. So
no, that would that would be 0 new household, right? Or no? Well, so if 2 households, okay, no, you're right. It would add 1 household. You're right. You're right.
So it obviously depends. It really depends. And sure, they might rent longer. I think a lot of millennials have the preference to live in a city, to live in a walkable area. And, that comes largely at the expense of delaying home ownership and building that equity. But that's their preference, or at least surveys show that, they have a preference for that, usually until they form families, have kids, then they really start to desire more space, less of living next to bars and restaurants. And so overall, you're right, though, that this wave of millennial demand, about 80% of the growth in households in between now and 2040 is going to be childless households. So these are boomers that are empty nesters. These are millennials that don't have kids. These are Gen Z buyers that maybe are just investing in an Airbnb property and not having a kid either. So, a lot of the growth in households is increasingly coming from, childless households. So you're absolutely right that can happen. But that does not necessarily mean that household formation overall is going to, take a big hit.
Okay. But family formation might.
Yeah, it definitely might.
Right. So in other words, like I'd say, fine, millennials are forming households. They're not forming families.
Yeah.
Right, because that's been consistent since about 2009, right? And and Pew Research, I think, did a study a while back. It freaked me the hell out, man. And what they're saying is 1 out of 4 millennials basically will never be married, right? And we've never seen that. Now, that's a projection. Who the hell knows, right? But then, like I pay a lot of attention to weird things that my wife is like, what the hell are you watching? And I'm paying a lot of attention to things like dating apps, right? I pay a lot of attention to things like dating, and she's like, "Are you?" No, it's because I'm interested in household and family formation, and the trends don't look good. The birth rates are lowest ever. But so it's the record lowest level. The previous record was last year. The record before that was the year before. You know what I mean? So it's just those are kind of things on the demographic side that I get worried about. But listen, we spent a ton of time. I do want to try and get down to, okay, so all this is the macro environment. And like I try to tell, listeners at the start, like I know it's a little bit boring, but this is stuff you have to know. I mean, you're obviously chief economist for Redfin, a real estate brokerage. You have agents. What do you brief your agents about? Like, what do you think the takeaways? So I'm a real estate agent. I'm a real estate broker. I'm not, econ nerds. I have no interest in any of that. I just want to know, what does this mean for me and how I should be thinking about my business? Like, what are you telling your people about that? If there's anything non-proprietary that you feel like you can share, what do you think they should be thinking about?
Well, these are really volatile times, so my advice is changing about every week, it seems. But if I look back to what has been the consistent message that I've been saying, it's largely, hey, if you're an agent trying to help a buyer find a home, emphasize patience, because it takes a while before you might find the right home. You might lose some bidding wars, and that's okay. Focus on patience and don't fall back on just focused on winning. Focus on patience to find the home that you can really live in for 5 to 10 years. Don't focus on, well, I just want to win and I'll buy a home and it'll be good for 2 years before I move up to a new property. The longer you stay in a home, the less risk there is in terms of the neighborhood you're buying in and how volatile prices might be or what appreciation will look like. Housing is an investment, but you can reduce the risk of that investment by just simply finding a home that you can really grow in. The second thing that I consistently say is don't try and beat the market and time the market with rushing on rates or rushing on prices. That can sometimes be a fool's errand because everyone else might be doing the same thing, and you might end up just overpaying trying to do that in the first place. So as a lot of buyers have really flooded into the market at the start of this year, trying to avoid rising rates. We actually saw this exact same thing 1 year ago when rates were rising, and a lot of buyers accelerated their plans to buy to get ahead of those rising rates. And as a result, we saw the most competitive April that we ever saw. And a lot of buyers were, perhaps overpaying to just save a few points on a mortgage rate. Instead, as mortgage rates are rising and do continue to rise, just know that will probably cool demand to the point that might ease competition. And even if you have a little bit higher mortgage rate, that lower competition could allow you to have an inspection contingency, overall just a healthier, safer offer for that buyer. And then if you're a seller, there's a totally different strategy, and the seller's agent needs to advise homeowners thinking about selling, in terms of how to prep their home to really make it shine the best. There's record levels of low supply, so it's pretty much a fantastic time to sell, so long as this person isn't a move-up buyer and also trying to compete at the same moment. So these are really challenging things for people trying to do that. The strategy I always give for homeowners that are thinking about selling but aren't quite sure what to do is try and look for ways to navigate the market where if you're selling a home in one neighborhood, where you're not moving into a more competitive neighborhood. So maybe you're moving to a different metro area or a less competitive neighborhood. That's really one way to get ahead in terms of selling a home and buying another. And you could still, get ahead that way. Look where demand is not quite as strong. And, you could perhaps come ahead a little bit that way too.
So let me understand if I understand correctly. It's what you're saying is, okay, if you're in the buyer, you should be more patient, buy the home that you think is more your permanent 5 to 10 year home. But we just spent the first 45 minutes talking about how home prices are going up 18% a year or 15% a year. Wage growth is flat. So unless you're job switching, which is not easy, right? It's not like something, okay, great. Next month I'm going to so it is actually a little bit more difficult. Rates are heading up. Inflation, nominal inflation 7.5, depending on what market you're in, it's 10, it's 15. And then it almost feels like the exact opposite would be true, no? Like if you're not a currently homeowner, right? So this is the important part. If you're currently a homeowner, yes, be patient, wait, because your asset is also appreciating 15% a year. If you're currently a renter, you're a first-time home buyer, like shouldn't the advice be get into whatever you can right the hell now?
I mean, if you had a high risk tolerance and you were willing to place your bet, stretch your income at the hopes that maybe your income is going to grow, you could do that strategy, but it is really risky. So that's where I emphasize patience, even for first-time home buyers. It might be that they're falling behind, but maybe they can't afford to buy a home then.
But what's the risk? So in other words, Taylor, you said the prices are volatile. I'm like, prices are volatile straight up and to the right. Now, granted, like we saw with the first housing bubble, it's straight up and to the right until something blows up, and then it's straight down, and the bubble has burst. The only volatility in the last 10 years is it's going to be volatile upwards, right? It's not like you're going to pay $300,000 for a home today, and then tomorrow it's going to be worth $150,000, right? Which is the first bubble collapse. Right? I mean, is that the risk that you're worried about?
So there's definitely a lot of households that are in really competitive neighborhoods, competitive metros. Think about people in Austin spending $200,000-$300,000 over asking on these properties that just simply might not be worth that much. Now, if they're going to stay in it for 10 years, that's fine. They can overpay and eventually, it'll balance out most likely. But if you're someone who, is just simply worried about rising rents and you're not sure how long you're going to be in this property, that is not the best strategy to just try and win. And you might overpay. If you overpay by 10%, and let's say you bought at the peak, we saw this happen to a number of households during 2018 as mortgage interest rates were rising. They rose about a full percentage point. And people who bought in right before that point in the fall of 2018, potentially overpaid and saw their home value. A lot of homes did actually see a decrease in value, even if on average prices were rising for the market price. A lot of households overpaid in the fall of 2018. And if they were forced to move during the pandemic, might have, sold flat at the start of the pandemic before we saw this record level appreciation. So it's not always, there's a lot of variation. A lot of metros are really at a high risk of prices coming down. CoreLogic actually puts out a report about what's the probability of on average prices coming down in some metros in the mountain region. I believe in Utah, Boise, Idaho, Austin, a lot of these places that saw skyrocketing home price appreciation are equally at risk of perhaps not continuing that up into the right movement. But for some properties that people are overpaying on, that their home value will ease down. And then there's other risks of they could lose their job. That puts them significantly underwater on a home. Now we're in a pretty good labor market, pretty good economic environment right now, but there is a lot of uncertainty on the horizon, especially this week as we enter into the tensions. So
yes, that's the final thing. So I have in here. Okay, so we kind of prepped for this call last week, and here's sort of the thing. At the time, we weren't staring World War III in the face, so we are now. I mean, does any of that change your thinking about kind of the housing market?
It does a little bit. So again, I keep emphasizing these are the most volatile times. Seems like every day, the market's up 3%, it's down 3%. Mortgage rates or treasury yields are up 10 basis points and they're down 10 basis points. We're getting some of the largest swings in both financial markets and bond markets. Even in housing markets, that we've experienced in a long time. And so I actually put out a post on our blog yesterday about how the Russian invasion of Ukraine could actually impact the U.S. housing market. Just simply trying to think out loud and process what are all of the ways that a conflict on the other side of the world could actually impact what's going on in today's housing market. So let me just outline 3 key ways. The first is simply that this is impacting global economic uncertainty that in general causes financial markets to typically fall. Though we've seen them kind of bounce back up, they're bouncing around, so it's hard to say exactly what's going to happen. But overall, investors don't like uncertainty, and this uncertainty over what's going to evolve in this conflict could overall depress financial markets, which could hurt down payments of some buyers, especially in pricey coastal tech hubs where they're more reliant on stock as a down payment. At the same time, investors are selling stocks and buying up bonds, which also eases bond yields. So the 10-year treasury, for example, fell about 15 basis points right at the invasion into Ukraine. And so that is actually one force that's moving, that's sort of anchoring mortgage rates down a little bit. They've been rising rapidly, and some of this economic uncertainty can really hold and sort of stop that rise. At the same time, though, it's rising in anticipation of further Fed rate hikes, and the invasion of Ukraine could amplify some of the inflation that we've been talking about, particularly in oil or other commodities that Russian has a big influence on. And so that increased risk of inflation will just further amplify the Fed's desire to sort of tighten their monetary policy, which simply means that could put more upward pressure on mortgage interest rates. And so we've talked a lot about how rates impact the market, but rising rates hurt affordability, they cool demand, they cool price growth, and they overall slow sales volume. So those are sort of different opposing forces that could be happening right now. And of course, rising gas prices ripples through the economy in a lot of ways, not just through inflation, but, through the cost of lots of goods that rely on gas. And and then overall, there's some markets in like South Florida that do have a lot of Russian foreign home buyer demand that, might cool off as well. So there's a lot of different nuances to what could exactly happen. But overall, I would emphasize there's just a lot of uncertainty, and that uncertainty is playing out in sort of these two opposing forces on mortgage interest rates right now.
On the flip side of things, the uncertainty, as you point out, again, referring back to the Ivy Zellman thing.
Yep.
If things are uncertain, investors are like, okay, I wanna find a safe haven. U.S. real estate seems like an awful good safe haven, awful nice safe haven. Again, if you're a Russian oligarch, okay, you're banned. You can't buy a U.S. But if you're French, if you're German, if you're European, if you are an American and you're just in whatever, I mean, isn't it entirely possible you actually see the housing market go through the roof because it is the safest asset class in the safest country, in the world? Like, is that a crazy hypothesis?
There's two opposing forces. The first is, you're right, investors might decide to shift assets out of equity markets and into things like real estate. And We're certainly seeing that happen, as we've been talking about with investor demand. But at the same time, this global shock of inflation and the hurting the pocketbooks of consumers could overall depress demand. So the question is really, which effect is larger? And if consumers are just so priced out of the market and they can't afford this 24% higher monthly mortgage payment, then they're going to back off the market. And as they're priced out, that decrease in demand is probably going to be greater than the investor demand. And, investors usually aren't large enough to really completely counteract that. And sometimes they can be. Maybe they're playing a large role right now, but a lot of that role is also played by iBuyers or home flippers. Home flippers at their core typically rely on that other pool of demands, the consumer demand. And if that consumer demand is backing off, iBuyers will be the first ones to say, we're not willing to take that risk. We're not going to continue betting on this price appreciation that we've been getting with just turning over homes at a large profit. So that's really, I think, sort of these two opposing forces that could play out here.
All right. Nobody knows. If we knew, we wouldn't be doing this, right? We'd be, starting giant funds and, making billions ourselves. But hey, Taylor, thank you so much for joining me. And again, I understand for the listeners, look, it is macroeconomics. But, I think right now, because the market is so volatile, as a real estate agent, as a real estate broker, as a real estate consumer, you want to pay at least a little bit of attention, right? Because this stuff is going to really affect how things play out. I mean, that's my take on it. And I think that's kind of your take on it as well. If there's ever a time to pay some attention to macroeconomics, I think the time is now. At least for the next several months, let's say, because things are so weird and so volatile. So with that, Taylor, if people need to find you, like, where do they find you?
Yeah, so we put all of our research on our blog at redfin.com/news. We put a bunch of data on there. We write articles, so you can find me there, or feel free to email me.
All right. And again, it's one of my favorite resources, Redfin. You guys do a phenomenal job of just some of the real estate data, just presenting it and kind of the interpretation of it. Whether we agree or disagree with the interpretation, that's secondary. The data is the data. So once again, thank you very much. And thanks for everyone for listening and sticking through a topic about macroeconomics. But like I said, it's an important one. So thank you, everybody.
Let's do it.